cash. Okay. Now it is not given to me the details about aggregate per day to the same person. Aggregate per day to the same person, that exact data has not been given to me. Okay. So I assume that this 23,200 is one single payment to one person in one single day. Then I will disallow 23,200 because it is expenditure and you are paying cash. Okay. So for that I have to write a very, very suitable note, because see, what is given to me 23,200 is a PNL. No, so this PNL is for the entire year. This is not a per day transaction. Okay, so that is something which I'll have to bring to the note. But I will write that particular note and I will say that okay, I will add 23,200, and with that particular note, that assume that this is one single day transaction with one person, cash exceeding the limit, and therefore I'll disallow. Now the depreciation provided in the profit and loss is 1,05,000, which was based on the following information. The written down value of the plant and machinery is 4,20,000. New plant falling under block 15% was brought on 1/7 of the previous year for 70,000. Two old plants were sold on 1/10 for 50,000. Okay. Now, wherever there is any depreciation, friends, at lower level, I have already explained that to you in detail that we have that block of asset system, and there's a special way in which we calculate the depreciation and all that. I already explained that to you in my lower level classes to you. However, see here it is a depreciation which is as per the books. Okay, so whatever is as per the books I will have to add, and whatever is a tax depreciation I will have to less. Okay, so add the book depreciation and less the tax depreciation. Okay. Now tax depreciation is calculated on a WDV of a block of asset basis. So I already have an opening WDV given to me as 420. 420. New plant falling under the same block of depreciation was purchased on 1st of July. So since it is 1st of July, that means it will be a full rate of depreciation. So I will add 70 to that particular block. Two of the old plants were sold for 50,000. So entire sale price will decrease it. So whatever that you have acquired and whatever that you have sold. Okay, this is how we do WDV, opening WDV, add whatever is acquired, less whatever has been sold. The entire sale price is reduced. In other words, in depreciation, in general, in income tax block of asset, we do not calculate depreciation for that individual asset because it is for the block of asset. Okay, so entire sale price gets adjusted into that particular block. Okay, so this is for like 40,000, and rate is already given to me in the question, that is 15%. Okay, and because of this 1st July it will be the full rate. Okay, and my tax depreciation will be less 66,000 rupees. So add book depreciation less the tax depreciation. Okay, update the answer. Okay, let me erase this now. Keep on updating the answer by yourself, baby. Mamma mia, Hakuna Matata means no worry. Sometimes no, I like to act, and I will satisfy my ego of acting, because I'm just in front of the camera. Sometimes I will do that. Mind it. Okay. Rent rates includes GST liability of 3,400 paid on 7th of April of the assessment year. Okay. So GST liability 3,400 is paid on 7th of April of the assessment year. That means just few days after the end of the year. The amount paid to the Indian Railways for the use of its asset, rupees 2,000, is paid on 10/4 of the assessment year. This is also just few days thereafter. Okay. Now, let me check GST liability. GST liability somewhere. Nowhere it is given to me in this particular details separately. So it is not anywhere, what should I say, debited here. Printing, stationery, laws, general expense, depreciation, rent rate, salary, purchase. Okay, fair enough. Okay. Amount paid to the Indian Railways is again 2,000 rupees. Again on 10th of April. Again, is there any of these particular items given to me here? Let me read it again. Rent and rates includes. So rents and rates. Okay, this figure. This already includes 3,400. It is already including, and it is 2,000. Okay. Now, friends, let me introduce a provision of Section 43B. First of all, Section 43B says that a specified expenses, I repeat, the specified expenditure will be allowed to you only upon the payment basis. Only upon the payment basis means you pay it and you get it. Okay, so you pay the expenditure of the previous year. In the previous year, you get that particular deduction. Okay, so see the time sequence. Expenditure of the previous year, you pay in the previous year, get the deduction. It should be expenditure of the previous year. Don't forget that. Okay, or even if you pay it before the due date of furnishing of the return of income, even if you pay it before the due date of furnishing of the return of income, that means after the end of the previous year. But if you pay this particular money here, that means after the end of the previous year, but before the due date, okay, then also it will be allowed to you as a deduction in the previous year. Okay, but only the specified items of the expenditure which is covered by Section 43B, only specified items, not all the items. Okay, so Section 43B, all these basic hardcore technical explanation I will give. But let me tell you that every time I will not refer the barrack because it is recent classes and initial classes rather. So I'm turning the pages maximum. Okay. Section 43B. Okay. Notwithstanding anything contained in the provision, deduction. Okay. Deduction otherwise allowed under these particular items, whatever these are all list of the expenditure. Okay. Okay. Shall be allowed. Okay. Only in computing the income referred to in Section 28 of the previous year in which such sum has been actually paid. Such sum has been actually paid. It should have been actually paid. That is one of the very basic and very important point of this particular clause. It should have been actually paid. Okay, and all these items of the expenditure should be kept in mind, and we should know that. See, one of the point is our GST, another point is some Indian Railways. So let's check it out. See, one of the point G is any sum payable by SSE to the Indian Railway for the use of the railway assets. So that is one of the specified transaction here. Okay, where any sum by way of tax, duty or cess. By way of tax, duty or cess. So that is also covered by these particular transactions. So this list of transaction one has to go through. So you get the deduction if you have paid in the previous year. Okay. Further, the proviso says, okay, nothing contained in this particular clause shall apply where it is actually paid by the assessee on or before the due date of furnishing of the return of income. Okay. So expenditure of the previous year. I repeat, expenditure of the previous year. If you paid in previous year, nothing wrong. But expenditure of the previous year you paid before the due date of the furnishing of return of income, then also nothing is wrong. You will get the deduction. Okay. So in the given circumstances, you will get 3,400, you will get 2,000 also. But they are already debited. No. See, we have already started the question with profit as per P&L. So when I have started profit as per P&L, naturally my profit of 50,000 is including all these things. Okay. So here you have to write a note that it is already allowed. This is already allowed. Okay. And you don't need to do any adjustments. No adjustments are required because it is already debited to the P&L. It is already debited. That means you already claimed it as an expenditure because answer we have started with profit as per P&L. Okay. Point number 6. Other business receipts include 2,200 recovery of excess expense paid on account of printing and stationery to Sham Stationers some 12 years back. Now other business receipts. Other business receipts. Where are those other business receipts? Other business receipts. They are including some 2,200 rupees. Okay. Recovery of excess expenditure paid on account of printing stationery some 12 years back. Now, very, very important concept. Rather, as I already told you, there is initial few question and initial few hours. I will just spend to explain you hardcore basic things, and thereafter I will go at a little bit of a extra speed from questions point of view. Now, first of all, section 41. Let me tell you. Section 41 is another principle, another concept. Okay. Section 41 basically says that if there is any expenditure which you have claimed in any particular year, and for that, if there is any recovery of the money in any subsequent years, there should be a link that there should be an expenditure of a year and there is a recovery in the subsequent year. There should be a nexus. And if it is proved, this nexus is proved, then whatever money that you recovered will be your deemed income. It will be your deemed income and it will be chargeable to tax. It will be chargeable to tax. Okay. Now, in the given case, business receipts include 2,200, excess expenditure of some earlier years. It is 12 years back, very long number of years back, but under section 41, any number of years under section 41. Okay. And no years limitation. The concept has to be kept in mind. Expenditure and there is a recovery. Okay. Then it will be your deemed income. Okay. Let me show you that particular barrack provision first of all. I'm just turning all these barracks so that you people know these provisions hardcore, very basic. Market is very important concept in fact. See section 41. Okay. Where any allowance, deduction has been made for any year in respect of loss, expenditure or a trading liability. Now this trading liability is a very important word here, but that I will explain it to you afterwards. Right now I will just focus on basic thing. Expenditure. Okay. So where you have claimed any expenditure for which any deduction has been allowed, see any deduction has been allowed. Okay. Then that is the beginning point of the discussion. Okay. Then you have obtained, whether in cash or in any other manner, okay, any of this particular benefit with respect to loss, expenditure or a liability. If you have obtained any benefit in cash with respect to any such loss, any such expenditure or any such trading liability, you have obtained a benefit. So in a 1 year expenditure, another year benefit. So you have already obtained 2,200 rupees. No, so 2,200 rupees is a benefit. You have got that particular money. And this particular money will be your deemed to be, this particular money will be deemed to be your business income. Technically it is called as a chargeable to income tax of that particular year. It is chargeable to income tax of that particular year. Chargeable to income tax. I normally call it as a deemed income. And in the given question, it is a perfect example of a section 41 deemed income. Okay. So it is anyway taxable. But we do not require any adjustment because it is already included in your 6,100. It is already offered to tax because we have started our answer with profit as per P&L. So profit as per P&L 50,000 includes all these figures. And so we don't want to double include that, and that's the reason no adjustment is required. But in any case, you will have to, keep on reasoning it that why you are not doing any of this particular adjustment. Okay. Next, any general expense include 2,000 paid as donation to a public charitable trusts. Okay. So any donation is not wholly and exclusively, section 37(1). It should be wholly and exclusively for the business purpose. So these 2,000 rupees, we will have to disallow. Okay. Other general expenditure. So other general expenditure is already debited somewhere here. See, this is other general expenditure. So here 2000 rupees is included. So we have to disallow. So because you have already debited, that means you have already claimed. So for this 2000 rupees, we will have to carry out the adjustment. So it will be plus 2000 rupees. Okay. Point number 8. Assessee had incurred expenditure relating to exempt income and the same was charged to the personal account, not debited to the P&L. So this is one of the very good principle that any expenditure which you do for earning exempt income, that means income is not taxable. Okay, so that particular expenditure also will not be deductible. Okay, so this particular amount, it was charged to the personal account, and since it is already charged to the personal account, that means you have not debited to the P&L, that means you have not claimed it as an expenditure. Okay, so that is the reason no adjustments are required, because it is not debited to the P&L. See, had it been debited to the P&L, then I will say add, because this is not an allowable item. But this item of expenditure for earning exempt income is not at all debited, so no need for any adjustment whatsoever. Okay. Point number 9. There was an earthquake in Nepal. So a local person of his locality were collecting some old household items to be forwarded to Nepal to help the victims. In that regards, one of his customer paid him 10,000 and requested him to buy kids' garments and then forwarded to Mr. Sham, who was in turn providing honorary services to help victims of the earthquake. Okay. Now, see, in this particular kind of a transaction, a doubt comes into our mind whether this 10,000 rupees you have, because in your hand you have received, no. So you have already got this 10,000 rupees in your hand. Okay, and thereafter you have purchased some kids' garments, and that garments you have forwarded to someone who is actually giving honorary services. Can we say that this 10,000 is an income of the assessee? Okay, this is also one of the very good principle, very good concepts, that see, every money that I receive is not my income. I repeat, every money that I receive, you cannot say that this is my income. It may not be my income, or it may be my income. There cannot be a general rule, general criteria that you receive the money. Okay, you received it, so it is your income. No, you cannot say like that. This will not work like that. Okay, so in that particular situation, I will say that this 10,000, although you have received, okay, this 10,000 is nowhere reflected here also. See here, nowhere this 10,000 is reflected in your profit and loss and trading account and all that. Okay, rather this 10,000 you should not even take it to your books of accounts, because this is not your money. You have just taken the money and purchased the kids' garment. It is not your money. You did not get good title to the money. Okay, so for which you require no adjustment. But here you have to write a very good note saying that this is not the income of the assessee, because money does not accrue to the assessee. Okay, further, point number 10, it says that other business receipts include following items. Okay, now friends, when I say that other business receipts include, first of all, let me go and check whether there is any other business receipts. Yeah, see, other business receipts is this figure, which is already there in my credit of the P&L and trading account. Okay, so other business receipts include blah 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 items and blah 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 adjustments. Okay, now each and every item I'll have to think like that, whether it is my business income, whether it is my income from other sources, or whether it is taxable or it is not taxable. Like this I have to think. Okay, so I have to keep on taking the decision, because I am right now computing income under the head business. So whatever these incomes that we are trying to talk about, is it income under the head business? Have you understood that? So that decision that we'll have to keep on taking. Secondly, friends, that if it is a speculative business, okay, and if there is any loss from a speculative business, so that you have to separate it from business income. That means inside a business we have to rather maintain, if there is any loss, speculative business, okay, because that carry forward set off which I already taught you at the lower level, that particular figure is what should I say, speculative loss. You have to maintain that particular records. Just one second, some call is there, one second. So I will have to naturally keep on knowing these particular items, whether it is uh, business items or not business items, and all that kind of situation. Okay. Now, non-compete charges. First of all, okay, a non-compete charges of 300 rupees. Now see, a non-compete charges are a type of a transaction where I have a competition and my competitor pays me money and it says that you don't compete with me, you don't carry out a particular activity, and for that I pay you some money. Okay, so if this kind of a non-compete charges, which is included in the business receipts, they are already taken as a business income by virtue of section 28. See, section 28, the charging section, no, now it takes care of lot of such transactions. One second, it will take care of lot of such transactions that one second, let me scroll, and it will tell you that these are the items which will have to be regarded as your business items or business incomes. Okay. Okay. If there is